In the depths of the 2008 financial crisis, a time marked by widespread economic turmoil and uncertainty, a pseudonymous individual or group under the name Satoshi Nakamoto introduced the world to Bitcoin. This mysterious figure, whose true identity remains unknown to this day, sparked a revolution in the financial world. This revolutionary concept, outlined in a concise white paper titled Bitcoin, a peer-to-peer electronic cash system, proposed a novel solution to the limitations of traditional financial systems. The white paper was a beacon of hope for those disillusioned by the failures of conventional banking. Nakamoto envisioned a decentralized digital currency, free from the control of governments and financial institutions. This vision was not just about creating a new form of money, but about establishing a new paradigm for financial transactions. This vision was born out of a growing distrust in centralized authorities. People were losing faith in the traditional financial system, which seemed increasingly prone to corruption and inefficiency. The 2008 financial crisis exposed the fragility of the global financial system. Banks that were deemed too big to fail were collapsing, and the ripple effects were felt worldwide. It highlighted the risks associated with relying on intermediaries to facilitate transactions and safeguard wealth. The crisis underscored the need for a more resilient and transparent financial system. Bitcoin, in contrast, promised a system where individuals could transact directly with each other. This peer-to-peer network eliminated the need for a central authority, reducing the risk of systemic failures. It would be a system built on trust in a robust, transparent, and immutable network. The blockchain technology underlying Bitcoin ensured that every transaction was recorded and could not be altered. The Bitcoin white paper laid out the technical framework for a peer-to-peer electronic cash system. It detailed how cryptographic proof could replace trust in third parties. It described a decentralized ledger known as the blockchain, where all transactions would be recorded and validated. This ledger was maintained by a network of nodes, each contributing to the security and integrity of the system. This distributed ledger would be maintained by a network of computers, ensuring transparency and immutability. The process of mining, where computers solve complex mathematical problems, was integral to this system. Nakamoto's vision was ambitious and far-reaching, aiming to revolutionize the way we think about and interact with money. It was a bold challenge to the status quo, offering a glimpse of a future where financial power was more evenly distributed. The introduction of Bitcoin marked a pivotal moment in financial history. It was the birth of a new asset class, one that operated independently of traditional financial markets. It presented a radical alternative to the existing monetary system. Bitcoin was not just a currency, it was a movement towards financial sovereignty and decentralization. Nakamoto's creation had the potential to empower individuals, promote financial inclusion, and reshape the global economic landscape. It offered a way for the unbanked and underbanked to participate in the global economy. The following sections will delve deeper into the core principles of Satoshi's vision and explore how Bitcoin has evolved in the years since its inception. We will examine the technological advancements, the challenges faced, and the impact Bitcoin has had on the world. Satoshi Nakamoto envisioned Bitcoin as a dual-purpose currency, serving both as a medium of exchange and a store of value. This dual functionality was revolutionary, aiming to redefine how we perceive and use money in the digital age. As a medium of exchange, Bitcoin would facilitate transactions between parties without the need for intermediaries. This meant that people could send and receive payments directly, without relying on banks or payment processors. It would enable seamless peer-to-peer payments, transcending geographical boundaries and reducing transaction costs. This was particularly significant for international transactions, which often involve high fees and long processing times. As a store of value, Bitcoin would provide a hedge against inflation and economic uncertainty. In times of economic turmoil, traditional currencies can lose value rapidly, but Bitcoin's design aimed to offer stability. Its limited supply, capped at 21 million coins, aimed to mimic the scarcity of precious metals like gold. This scarcity is a key factor in its potential to retain value over time. This inherent scarcity, coupled with Bitcoin's decentralized nature, positioned it as a potential safe haven asset. Unlike traditional currencies, which can be printed at will by central banks, Bitcoin's supply is fixed and predictable. Individuals could protect their wealth from the devaluation of fiat currencies and the volatility of traditional markets. This made Bitcoin an attractive option for those looking to diversify their investment portfolios. Nakamoto's vision for a dual-purpose digital currency was ambitious. It sought to challenge the existing financial system and offer a new way to think about money. It challenged the conventional separation of money's functions. Traditionally, money has been seen as either a medium of exchange or a store of value, but rarely both. Bitcoin's success in fulfilling both roles would depend on its adoption by merchants and users worldwide. For Bitcoin to become a true medium of exchange, it needed to be widely accepted for everyday transactions. It would require the development of a robust ecosystem to support its use in everyday transactions. This includes everything from payment processors to ATMs and user-friendly wallets. The early years of Bitcoin were marked by experimentation and exploration. Enthusiasts and developers worked tirelessly to build the infrastructure needed to support Bitcoin's dual roles. Its value fluctuated wildly as early adopters tested its potential as a medium of exchange and a store of value. This volatility was both a challenge and an opportunity, attracting speculators and investors alike. While its use in commerce was limited, its decentralized nature and potential as a hedge against inflation attracted attention. People began to see Bitcoin not just as a currency, but as a revolutionary technology with the potential to change the world. Bitcoin's journey from a niche digital currency to a globally recognized asset class is a testament to the enduring appeal of Satoshi's vision. Today, Bitcoin is not just a financial instrument, but a symbol of innovation and the future of money. At the heart of Satoshi Nakamoto's vision for Bitcoin lay the principles of financial sovereignty and privacy. These principles were not just abstract concepts, but were meant to address real-world issues and provide tangible benefits to users. Bitcoin aimed to empower individuals by granting them greater control over their finances. This empowerment was envisioned as a way to democratize finance, making it accessible to everyone regardless of their location or socioeconomic status. It would achieve this by removing intermediaries from financial transactions and providing a degree of anonymity. By eliminating the need for banks and other financial institutions, Bitcoin transactions could be faster, cheaper, and more secure. Users would have the freedom to transact without the need for permission or oversight from banks, governments, or other centralized authorities. This decentralized nature of Bitcoin was a revolutionary shift from traditional financial systems. This emphasis on financial sovereignty was particularly significant in the context of the 2008 financial crisis. The crisis shook the global economy and eroded trust in traditional financial institutions. The crisis exposed the vulnerabilities of centralized financial systems. It showed how interconnected and fragile these systems could be, leading to widespread economic turmoil. It highlighted the risks individuals faced when their financial well-being was entrusted to institutions prone to mismanagement and corruption. People lost their savings, homes, and jobs, leading to a search for alternatives. Bitcoin offered an alternative, a system where individuals could be their own banks, responsible for securing and managing their own wealth. This self-sovereignty was a powerful concept, giving people direct control over their financial destiny. While Bitcoin was not designed to be completely anonymous, it offered a level of pseudonymity that enhanced user privacy. This meant that while transactions were visible on the blockchain, the identities behind them were not easily traceable. Transactions on the Bitcoin network are recorded on the public blockchain, but they are not directly linked to real-world identities. This transparency combined with pseudonymity created a unique balance of openness and privacy. This pseudonymous nature of Bitcoin transactions appealed to individuals who valued their financial privacy. It provided a way to conduct transactions without exposing personal information, which was particularly appealing in an age of increasing digital surveillance. However, the pursuit of financial sovereignty and privacy through Bitcoin was not without its challenges. Users had to be vigilant about security, as the responsibility of safeguarding their assets rested entirely on their shoulders. The pseudonymous nature of transactions raised concerns about illicit activities. Critics argued that Bitcoin could be used for money laundering, tax evasion, and other illegal activities. Regulators grappled with how to balance the need for oversight with the desire to foster innovation. They faced the challenge of creating frameworks that could prevent misuse without stifling the growth and potential of this new technology. The challenge for Bitcoin, as it matured, was to address these concerns while remaining true to its founding principles of empowering individuals and promoting financial inclusion. The ongoing dialogue between the Bitcoin community and regulators aimed to find a path that would allow Bitcoin to thrive while ensuring it could be used responsibly. Decentralization formed the bedrock of Satoshi Nakamoto's visionary concept for Bitcoin. Unlike traditional currencies issued and controlled by central banks, Bitcoin would operate on a decentralized peer-to-peer network. This network, maintained by a distributed network of computers, would ensure transparency, security, and resilience. The decentralized nature of Bitcoin had profound implications for its functionality and governance. No single entity would control the Bitcoin network. Transactions would be validated and added to the blockchain through a process known as mining. Miners using specialized hardware would compete to solve complex mathematical problems. The first miner to solve the problem would add the next block of transactions to the blockchain and receive a reward in Bitcoin. This decentralized architecture made Bitcoin resistant to censorship and manipulation. No single entity could alter the transaction history or prevent transactions from being processed. The network's distributed nature also made it resilient to various types of attacks. Even if a portion of the network went offline, the remaining nodes would continue to operate, ensuring the integrity of the blockchain. Decentralization was not merely a technical feature of Bitcoin, it was a philosophical underpinning. It reflected a deep-seated distrust of centralized authorities and a desire to create a more equitable and transparent financial system. The success of Bitcoin in maintaining its decentralized nature would be crucial to its long-term viability and its ability to fulfill Satoshi's vision of a truly peer-to-peer electronic cash system.